In today's video, we're going to answer a very common question that I get quite often, which is how to choose your life insurance beneficiary. What are the different types of life insurance beneficiaries? And make sure you stick to the end of the video because I have something in here that's very important if you're listing your children as a contingent beneficiary. So make sure you watch the end to figure that one out. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which, if you haven't heard of us, we're an online life insurance platform here in Canada where you can actually view quotes 100% online and apply 100% online as well. So if that sounds interesting, I'll put the link in the description below and you can check it out. But without further ado, let's get right into the video. Okay, before we get into life insurance beneficiary and how to pick one, I'll just go over the basics of life insurance here real quick, just so we're on the same page and you understand what I'm talking about. So life insurance here in Canada, very simple to understand. You have a life insured, you pay an amount to the life insurance company. If you pass away, the life insurance company will then pay, of course, your beneficiary a certain amount, and that's what's known as the face amount. Now, we have two different types of life insurance here in Canada. We have term life insurance and permanent life insurance. Now, term life insurance is incredibly easy to understand. It's the most inexpensive option. It's 99% of the time the best option for most Canadians, and it's really just meant to cover you for that one specific period of time. So you can pick different terms, such as a term 10, a term 20, or a term 30, and in that period, it's a fixed rate, and if you were to pass away, your beneficiary would receive that face amount. This is really good for individuals that are looking to protect their family for a very specific period of time. So maybe you just bought a house, you just got married, you just had kids, you bought a car, you have some outstanding debt, and if you were to pass away, and your loved ones would be very financially impacted. So this is really good option for that majority of Canadians. Now, permanent life insurance, on the other hand, is now not a what if, it's a when. So this is meant to cover you until death. Now, there's two different types. We have whole life and universal life, and I'm not going to get into them in this video. I made other videos about that, and if you're interested, just drop a comment below and I'll send them to you. However, this is now really used for estate planning. Maybe you want to leave something behind to the next generation, such as kids or grandkids, or maybe a charity, or maybe you have taxes upon death that you want to take care of as well. Now, you may have heard other individuals, other advisors talking about investing in life insurance, and maybe you should buy permanent life insurance so you can use it during retirement. Now, I would say this is a bad idea for the vast majority of Canadians. For the few Canadians that are the high income earners that have already maxed out their RSP, their TFSA, and they don't have any high interest credit card debt, I would say it might be a good idea. But for the vast majority of Canadians who aren't there yet, this is a bad idea, an easy way to waste money on life insurance. And again, I made a lengthy video about this, how it actually works, compare it apples to apples to an RSP. If you're interested in that video, drop a comment below asking for investing in life insurance video and I will send it to you. But let's get into beneficiaries of life insurance. Now, a beneficiary is exactly what it sounds. I mean, this is essentially who is getting paid the face amount of the life insurance, and this could be a number of different individuals. So in most cases, 9 times out of 10, of course, it's the partner, but it also could be, the spouse, the partner, common law, could be children, could be siblings, could be friends, could be a corporation, and it could be a charity as well. So there's quite a few different individuals or corporations or types of people that are eligible to receive this face amount, and really who you want to pick is up to you. Now, there's two different types of beneficiaries. There's what's known as a primary beneficiary and a contingent beneficiary. And let me explain how this works. A primary beneficiary is essentially first in line to get those life insurance proceeds, okay? Now, you can have one primary beneficiary or you could have multiple primary beneficiary. Now, of course, you need to tally it all up so it equals 100%. So let's say you had maybe your brother and your sister, and they're both 50% primary beneficiaries. Well, of course, in the event if you passed away, they would each receive 50% of the face amount. So you could set it up other ways as well. Maybe 75% goes to your partner and 25% maybe goes to a business associate or something like that. Now, the other one that I mentioned is a contingent beneficiary. So what is a contingent beneficiary? That's essentially the second in line individual that's going to get the life insurance proceeds if for whatever reason the primary beneficiaries are deceased at that point. So why would that happen? Well, if you think about it, if you listed your spouse as the 100% primary beneficiary on your life insurance application, then if you guys, let's hypothetically say, are both driving to see a movie, or you're driving on a road trip or something like that, and your child is not with you, and you both got into a car accident, you both passed away, well, now your primary beneficiary would essentially be passed away at that point. So the contingent beneficiaries are there to be the next in line to receive the proceeds of the life insurance if the primary beneficiary is deceased. And again, you're not tied to just one contingent beneficiary. You could have multiple different contingent beneficiaries as long as it equals, of course, 100%. So you could have, 1, 3, 5, 10, or whatever it is. Now, what happens if you don't have a beneficiary when you pass pass away, maybe the primary beneficiary passed away, maybe the contingent beneficiary passed away. What if there's no beneficiary named or no beneficiary available to take the face amount? Does a life insurance company keep the proceeds? Do they keep the face amount? No, 100% not. The life insurance company does not keep your proceeds. What happens then is your estate would receive those life insurance proceeds. And now there's a few things that can go wrong with this. Obviously, if you're not familiar with how taxes work upon death and how estates work upon death, I made another video. Drop a comment, I will send it to you. However, in a nutshell, this is what happens. When you pass away, everything that you own is essentially wrapped up into this estate. And if you have a will, it'll be distributed according to your will. And if you don't have a will, you'll die in what's known as intestate, meaning that you don't have a will, you died intestate. And what happens then is it's distributed according to local guidelines. So depending on what province you're in, maybe Alberta, maybe BC, maybe Nova Scotia, maybe Ontario, it's different in each and every province, but essentially it's going to get distributed to the next of kin. So with your life insurance proceeds, if they got paid into the estate, well, it's going to go exactly where I just mentioned. And another thing that happens within the estate is there's probate within the estate. Now, in some provinces, that's just a flat fee. It could be $500. In other provinces, it's a percentage, and it could be 1 or 2%. And if you had $1 million face amount, you can start to see how they would take quite a bit of that face amount. So making sure that you have a beneficiary listed on your life insurance application and you have some contingents there just in case is a really good idea. Now, there's two ways you can structure the beneficiary. They can be revocable or irrevocable. Now, you may have seen this on a life insurance application, or may have heard of it before, but if you haven't, let me explain it to you. Revocable is exactly what it sounds. You list your spouse as a revocable beneficiary. That means that you can change it on your own without their permission anytime you would like. If you don't want them on there anymore, if you want to change it to another individual, if you wanted to take them off altogether, or you wanted to decrease their percentage or increase their percentage, you can do that all without their permission, without having to ask them first. Irrevocable, on the other hand, you need to get their signature for anything that you want to change on the beneficiary designation. So you can see how this gets a little bit more complicated. If you wanted to change things, maybe add someone else, maybe you had some type of matrimonial breakdown, you didn't want them on there anymore. Well, if they were a irrevocable beneficiary, you would need their written permission first. So make sure you consider those two options when picking a beneficiary. Now, here's one thing I'll talk about at the end of the video, which I mentioned was very important. And this is something that a lot of people do, and it's something that they don't really think about, and it's fine. I mean, we're going to talk about it in this video and you'll be prepared, and at least you'll know what the consequences are of either action. So what a lot of people will do is, of course, they will list their partner as the primary beneficiary, and then they will list their children as the contingent beneficiaries. So you're probably thinking, well, wait a second, how does that work? If me and my partner pass away and the primary beneficiary isn't there anymore and my underage child gets $1 million, like how does that work? Well, let me explain how this works, okay? If you list your child as a contingent beneficiary on a life insurance application, what will happen is if you pass away and your partner, the primary beneficiary, pass away, this face amount will go into a trust. And this is what's known as a life insurance trust. And essentially you need to list a trustee of this. And if you don't, then it'll be handled by, again, local guidelines, whatever province you're in. But let's say the trustee is your sister or your brother. What's going to happen is they will manage the funds of this trust until your child reaches age of majority. And if you have multiple children listed on this, it's until each of them reach the age of majority. And again, then it would depend on what percentage they are. However, this is where, in my opinion, it kind of breaks down, even though it's really easy to do because it's just a little box that you put on the life insurance application and you list a trustee. The problem that I have with this is there's no stipulations to when the funds are paid out. They're 100% paid out at age of majority. So just think about this for a second, okay? If you have children, and I don't know about you, okay? But if I received, let's say, $1 million or $1.5 million or $2 million at age of 18, which is the age majority in Alberta here, that I do not think would be a very good idea. There's no stipulations on how I'm allowed to spend it. I would just receive a check for $2 million at age 18, having zero life experience, not knowing what to do with it. I would probably spend $2 million in 2 or 3 years. I would buy a Ferrari, I would buy a Lamborghini, I would take all my friends on vacation, and I would be broke within 2 or 3 years because I'm 18 years old and I have no idea what I'm doing. That's one of the problems I have with listing a underage child as a contingent beneficiary on a life insurance application. So you're probably asking me, well, what's the alternative? What are we supposed to do? The other thing that you can do is create what's known as a testamentary trust, okay? So how this works is you would not list your child as a contingent beneficiary on the life insurance application. You would actually go and talk with a lawyer and set up up what's known as a testamentary trust. And of course, this would get a little bit more expensive and there'd be more things involved with it. However, in my opinion, it would be much more valuable because now you have complete control over how you would like those funds to be allocated. So let me explain what I mean by that, okay? Now you essentially have this document known as the trust deed that if you were to pass away and your primary beneficiary were to pass away, then the trust, the testamentary trust would be created upon both your deaths. They would receive the life insurance proceeds. There would still be a trustee, but now you can create this deed and say exactly what you want to have done with these funds. So one of the more typical or one of the more common ways that I've seen this accomplished is having a percentage allocated at age of majority. Maybe it's 10%, maybe it's 15%, maybe it's 20%. And then saying that they can have unlimited access if it's for the purposes of post-secondary education, if it's for the purposes of investment income, if it's for the purposes of starting a business, but they can't go out and buy a Lamborghini and a Ferrari and a mansion, etc., etc., etc. So that's one way I've seen it structured. Another way is you can structure it tiers. So what I mean by that is maybe they receive 20% at age of majority and then 20% 3 years later and then 20% 3 years later. Even that is a much better option because it'll start to teach them a little bit of money management and they'll start to see like, oh, okay, I can't just spend it all in 1 year because then it's gone the next year. And so you could structure it in a way where they receive access at different times and it's completely flexible. You can create this any which way you want. So I would say if that's on your mind, that would be a good option to go. It's a little bit extra work, but I think much more beneficial in the event that something did happen. Now, I hope you guys enjoyed this video. If you guys have any questions, feel free to drop them in the comments below. And if you guys are enjoying this video, as always, all I ask is that you give it a thumbs up and I'll see you guys in the next one.